So when it comes to annuities, the basic idea is you're entering a contract between you and an insurance company. You'll give them a lump sum or a series of payments, and in exchange, they'll give you a series of payments or a lump sum. You have two phases. You have the accumulation phase and the payout phase. And overall, I don't want to scare you. When you think about an annuity, it's not an investment. It is really, for example, an insurance policy. And the idea comes into play, Tommy, what are the best types of annuities? Now, when you go to an insurance company, they have a lot of products, okay? I've gone to some and seen, for example, 13 different types. But in this video right here, I'm going to tell you about 4 basic types of annuities. So this way, you have the overall idea, because the other products are usually just variations of these 4 right here. So in this video, I'll break everything down step by step. And as always, guys, do me a favor and smash the like button. Now, first, there's something called, for example, an immediate annuity. Now, this basically means exactly what the name actually says. Immediate, okay? You are going to agree with the insurance company to hand them over a lump sum of cash. And in exchange, they're going to guarantee you a series of payments every single month for the rest of your life until you basically die. That's the idea. Now tell me, why would I do this? What is the gamble, and how do they actually make money, okay? And how can I make them lose money? The idea is no one is going to do business to lose money. And if insurance companies have been doing this for such a long time, it's usually because they're also making money. Now, the idea is when you hand them over this lump sum of money, they're going to give you a good return. Usually about like 5 to 6% to 7%. That's going to be the payments you're actually going to be making. Now, the gamble is that if you have, for example, a death, before you can actually get a bunch of money out, then they usually keep the rest of the money. That's basically it. That's the agreement, right? Now, on top of that, if you outlive, right, if you outlive what they think you're going to outlive, then you get a lot more money than you actually gave them. And in reality, you benefit. But no, you don't benefit, because you also have the idea that I gave them all this money. They can invest that money, make a big return. They only give me a part of the money. So overall, the insurance company does not lose. The only way they lose is basically that if I entered with them into a contract and I gave them $1 million, in exchange they gave me an agreement to pay me $5,000 every single month, no matter what, okay? Well, if we have, for example, a big problem, right, in the economy, and the economy crashes for the next 30, 40 years, and that basically means that $1 million, they can't really invest it to make a bunch of money off of it, right? So I'm going to be making a lot more money than they will. So in this case, I benefited, right? That's the overall idea. But the chances of that actually happening are very slim. And you also run the risk that although the insurance companies also are insured in some ways of potential collapse, those things are real. So there is no risk-free business here. I just want you guys to consider that too. But an immediate annuity is you giving them a lump sum in exchange for a series of payments forever, and you get that payment immediately, all right? That's the idea. Usually like within 6 months to a year, you'll start getting those payments right away. Now, number 2, guys, is going to be deferred annuities. Deferred annuities are annuities that actually are deferred, right? Deferred. You don't actually get the money now, but this money can actually grow fully tax-free. So as your money grows, it grows tax-free. And then once you actually get the lump sum at the end, that's when you pay taxes. Or when you get the series of payments at the end, that's when you start paying taxes. So if you have an annuity, well, the money the insurance company starts to pay you, or the money your investments within the annuity actually make, well, in reality, that's going to grow tax-free as if it's actually a retirement account in a sense, all right? That's the overall idea. Now, I do want to comment here. Does this mean I should invest into an annuity instead of investing my money into my 401k or my Roth IRA? The answer is no. An annuity is something you actually do in addition to, but you should still be investing your own money. Why? Because that money can actually grow at a higher rate. It's actually your money 100%, and you have more liberty. While, for example, you can have an annuity and you can have, for example, a surrender charge, which basically means, hey, you change your mind, good, but if you try to take the money out before like 7 to 10 years, we're going to take a big chunk of it, or we're going to take, for example, a big fee. That's the whole idea, okay? So you want to be careful with those things. Having your own thing gives you more liberty, and there's also a lot less fees, because annuities, these insurance companies, they don't just make money from your money, they also make money from fees and everything else. So consider that, okay? Now, number 2. here are the overall real two basic types of annuities. You have fixed annuities and variable annuities. You know, the rest of the stuff is like more like different products and different variations, but for the most part, you have fixed annuities and you have variable annuities, okay? So a fixed annuity is saying, hey, I'm going to agree to give you this series of payments for 20 years, 30 years, whatever the time is. And in return, well, I'm giving you that money is actually going to earn me a fixed amount of interest. That might be 3%, that might be 4%, that might be 5%. It all depends on current interest rates. That's the idea. But you will not profit from making more money, and you will not lose more than what you actually agreed to. That's the idea, right? So if I'm saying like, hey, I'm going to agree to pay you this amount of money, you're going to pay me 5%, and the interest rates go down like severely, the market crashes, everything goes down, terrible, okay? Well, interest rates actually go up because that was what actually crashes, and everything just goes down terrible. I'm still going to get my 5%, okay? Well, the market actually does well. You know, interest rates actually go down. You know, people have more money in the streets. Market actually does a lot better, right? And they're actually making 10, 12%. I'm still going to be making my same 5%, okay? That's the idea. Now, you have number 4, variable annuities. Variable annuities are what they sound like. You actually grab that money and they're usually invested into mutual funds and index funds, right? And that money actually grows and it actually varies on the amount of interest you're actually going to earn dependent on the performance of your underlying assets. Basically saying, well, I put my money into the S&P 500. That made 12% that year. Next year might make 8%. Next year might make 7%. So it varies, right? But there's still the fees that you're actually going to have to pay the insurance companies. That's basically what it is. You have fixed, you have, for example, variable, you have deferred, you have immediate annuities, but that's usually like different type of products. But the overall idea is you have fixed and you have variable. One that actually pays you a fixed amount, and the other one actually varies in what you're actually going to make by you taking a little bit more risk, okay? The risk is that it might vary. Some years you might actually not make any money. And sometimes they actually have like a guaranteed amount of money that you're actually going to make that's actually into some contracts too. So they might say it varies, but you're not going to make less than 3%, okay? Or 2% or 1% or whatever it is. That is the overall idea when it comes to annuities. So overall, guys, those are the main 4 types, but I also want to answer questions. Tommy, who are annuities actually for? Are they actually an investment? Should I invest into one? The answer is, first of all, annuities are for people that want to basically have a guaranteed fixed amount of income or want to make sure they actually get a big lump sum at the end of retirement or while they're in retirement that they know for sure they're not going to run out of money or at least not have to worry about that portion of their income actually being lost out because they're making this agreement to say, hey, I'm going to pay you a series of payments, but in return, you're going to give me this fixed amount of money every month until I basically die. Now, is it an investment? The answer is no, because if you grab your own money, invested it yourself, lower fees and everything else, you could actually make more money, but you also run the risk of like, hey, you might retire, you're in a time when the market is down, and you might not be able to make that much money. That's the idea. Now, do I recommend them? The answer is I would recommend an annuity in addition to having a normal retirement account, okay? So that basically means that, yeah, if I retired and I have, for example, $1 million and I want to get an immediate annuity, I would give them like $250K, get $1,000 every single month. But the other money, I would actually invest it, take out 5% or 4% of that money every single year, and have, for example, this guaranteed portion and have this variable portion that I actually get to actually maximize everything. You know, this way, this one can actually grow. But an annuity, the idea is, okay, insurance companies don't lose. They understand longevity risk. They understand mortality risk. They also understand like the average lifespan of a human being. So they know how these things work. And the odds are they're going to win. When they have, for example, a bunch of people, hundreds of thousands of people, millions of people actually paying them premiums and all this money. Well, when people actually live longer or whatever, it doesn't really matter that much, right? Because most people aren't going to be the case, okay? So that's the overall idea here. Do I recommend them? Yes. But only in addition to. It gives you more peace of mind, but it's not an investment in a sense, okay? That's the idea. Me personally, I would have an annuity to pay me out like $1,000, $2,000 per month, but I would still have, in addition to that, my variable investments, my own variable investment that actually pay me out money that vary, but they're still going to make me more money overall than an annuity. I wouldn't use an annuity as my only source. That would be not great whatsoever. And I would never invest into a fixed annuity because I'm basically saying I'm just going to get this amount. And you're only usually doing that because you're scared that the market might go down. But if you're going to be doing it for a long time, you got to get over that. And you got to be able to understand that, hey, I'm investing for the long term, so I don't have to worry about this that much. That's the idea. Thanks for watching. That's it though. If you made it all the way to the end of the video, comment down below I made it, so you knew I made it all the way to the end. If you have any questions like taxes and what about if I die early, well, I have more videos on that too. So make sure you watch those videos too and subscribe to the channel because I have more of those even coming out. Up here is another video. Over here's my face. And as always, long-term team officially out.